Welcome to this explainer. Today, we are diving deep into a massive, data-driven due diligence report on United Airlines. We've come through a mountain of recent SEC filings and earnings data to give you a really clear, unobstructed view of this aviation titan. You know, the airline industry is famous for its razor-thin margins and high macro sensitivity, so we have to ask, how is United actually navigating this airspace right now? Let's get right into it.
To cut right through the noise, we've broken our analysis down into 5 key areas: valuation and market footprint, recent earnings data, global row growth, the balance sheet, and finally, market sentiment and outlook. All right, Section 1, evaluation and market footprint. Let's establish the sheer scale of United Airlines right out of the gate. Anchoring our valuation check is United's massive market cap of over $38 billion. But honestly, what is truly staggering here is the momentum behind that number. We're talking about a year-over-year market cap growth of over 31%. In a mature, heavily cyclical industry like aviation, a 31% expansion in a single year tells us that Wall Street is aggressively pricing in a major operational recovery and serious future earnings power. The market isn't just looking at United as some old legacy carrier anymore. They're actually rewarding it for tangible, forward-looking growth. When we break down the recent valuation metrics, a pretty fascinating narrative emerges. We're looking at a PE ratio of 11.06 and a remarkably low PEG ratio of just 0.49. Now, since a PEG ratio under 1 usually suggests a stock might actually be undervalued relative to its growth, well, that's a really key signal for us. Throw in a price-to-book of 2.30 and an EV-to-EBITDA of 11.37, and despite that massive 31% growth we literally just talked about, these multiples suggest United is still trading at what a lot of folks would consider a discount. Moving right along to Section 2, unpacking recent earnings data. Let's look under the hood at the actual engine driving the company, because multiples are only as good as the earnings supporting them. Before we get to the raw numbers, it's absolutely crucial to note that management heavily emphasizes non-GAAP metrics. Why? Well, airlines deal with wild, unpredictable fluctuations. Think crazy spikes in jet fuel prices or weird one-off special charges. By stripping all that out, non-GAAP figures help us cut through the noise so we can see the airline's true underlying operational run rate. And looking at that earnings trajectory, we see a massive step up from Q1 to Q2. Back in Q1, United posted $0.7 billion in net income with an EPS of $2.14. Fast forward just one quarter, and net income climbs to $805 million, pushing EPS all the way up to $2.46. This quarter-over-quarter growth is textbook operational leverage. They aren't just flying more planes, they are actively keeping a much larger slice of the revenue. That brings us to Section 3, global revenue and route growth. So where exactly is all this cash actually coming from geographically in a post-recovery world? Well, the Atlantic and European routes are just the undisputed heavy hitters for United's international footprint, generating well over $6 billion combined in Q2 alone, with the Atlantic pulling in $3.42 billion and Europe right behind it at $3.19 billion. It really highlights United's structural reliance on transatlantic travel. It's a historically lucrative corridor driven largely by premium business and leisure travelers. But check out this shift in global travel demands. We are seeing a massive 18.7% growth surge happening right now in the Pacific region. So while the Atlantic and Europe bring in the bulk of the raw dollars, the Pacific is delivering absolute explosive growth, totally outpacing the Atlantic's 7.9%. Add in robust double-digit growth from Latin America and Europe, and it's clear United is successfully capturing surging demand across entirely different global markets, all at the exact same time. Okay, Section 4, balance sheet and cash flow. Now that we've mapped out the revenue, let's zoom out a bit and examine the financial foundation supporting this massive global operation. Because airlines are notoriously capital-intensive businesses, right? You have to buy the planes, maintain them, buy the fuel, and pay highly specialized labor, all before you even sell a single ticket. So it begs the fundamental due diligence question. How healthy is United's balance sheet, and can they actually handle a macroeconomic shock?
Here is the objective reality of their financials. Yes, they carry a pretty hefty debt load, hovering somewhere between $24 and $26 billion. But that is significantly offset by an impressive $17.2 billion in available liquidity. And honestly, even more compelling is their cash generation. We're talking an incredible $4.8 billion in Q1 operating cash flow, leaving them with $2.9 billion in free cash flow. This kind of robust cash generation is exactly what lets them comfortably service that massive debt, while still having plenty of capital to reinvest back into the fleet.
Finally, Section 5, Market Sentiment and Outlook. Let's pivot from United's internal ledgers and look at external market sentiment. How exactly is Wall Street digesting all this data? The media landscape presents a bit of a mixed bag, but there are definitely some genuine bright spots out there. For instance, analysts are pointing to very positive operational developments, like encouraging tidings regarding United's labor relations. In an industry where pilot shortages or the mere threat of a strike can literally ground a fleet and destroy a quarter's earnings overnight, securing labor stability is an absolute premium tailwind for sure. However, to be totally impartial here, we have to note that United currently carries a Zacks rank number 4, which is a seller rating. So why is Wall Street so cautious despite those massive cash flows? Well, the broader market is wrestling with some incredibly complex macroeconomic trends. While there are tailwinds, like easing inflation and rebounding U.S. manufacturing, there is also a massive capital rotation happening. Investment dollars are heavily shifting away from traditional cyclical stocks and pouring straight into AI infrastructure and tech. Sometimes a stock's rating reflects the broader market's appetite for the whole sector just as much as the company's actual internal performance.
So we arrive at the ultimate crossroads. When you weigh the undeniable operational growth, the surging Pacific routes, and that massive cash generation against a significant debt burden and cautious Wall Street ratings, what do you think? Is United Airlines poised to soar past expectations, or will macroeconomic turbulence keep it grounded? Keep digging into the data, keep asking those hard questions, and hey, thanks so much for joining me for this explainer.